Welcome to another presentation of Capital Economics. We will be continuing our analysis of the business cycle. Today's presentation is going to be focusing on, once again, recessionary indicators. So recession, the economic puzzle pieces. Today we will be discussing average hourly earnings, average weekly hours in real income. So let's get started. So to be consistent with our previous presentations, which of course you can find on thecapitalnews.com or our YouTube channel, The Capital News, we want to make sure that the audience is on the same page, because if you're following the financial mainstream media or simply listening to some pundits or politicians, they are likely to define a recession as 2 consecutive quarters of negative GDP growth. Now, that may be the quote-unquote technical definition of a recession, but we are going to be focused here on the National Bureau of Economic Research. This is the team, the committee within the NBER, who makes the official determination of a recession. So anytime that you're following along with a lot of economic data, if you're looking at a lot of graphs, whether it's government sources or private sources, if they offer some sort of economic shading on their charts and graphs, which we do here during our presentations, they are highlighting the National Bureau of Economic Research. So with that said, I just want to make sure that we're all on the same page. And with that, we have a recession is a period of falling economic activity spread across the economy lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. Okay? So it's not just GDP. It's a handful of other items. And in previous presentations, we have highlighted employment. We will be getting to the rest of them because other presentations have been highlighting the yield curve of varying durations, other things that are leading indicators for a recession, or that it's showing a peak in activity, that we are reaching the peak of the business cycle. And just so everyone also understands, we are currently in the midst of the longest expansion of any business cycle that we have experienced here in the United States since we have been keeping records. So that's also something to keep in the back of your mind. So again, the handful of things that we're going to be talking about today are hours, earnings, and income. Okay? So with that said, let's get started with some of our material. So the first chart here, we're going to be looking at average hourly earnings of production and non-supervisory employees. Okay, and this data, you can find this from the Bureau of Labor Statistics, or FRED, that is Federal Reserve Economic Data. These are sources that we use constantly, and we advise that you take the time to do so. And as I just previously stated, these vertical bars here, these are indicative of recessions, U.S. recessions, and of course the thickness of these lines is indicative of the duration or severity of the recession. We have 7 recessions here going back to the early 1970s and continuing all the way today, with the most recent being the financial crisis in the Great Recession that ensued in 08 and 09. Okay, so here, average hourly earnings of production. Now, for those of you who have been following my podcast, The Capital News, or previous capital economics presentations, I do believe, and I'm not alone in believing this, that we are currently in a different paradigm within our financial market structure. And this has sort of been the way things have been operating probably for the last 30 years or so. Pretty much when Alan Greenspan, the former chairman of the Federal Reserve, in my opinion, stepped onto the stage and really started to intervene in the markets, particularly the stock market. It wasn't enough just to focus on the Federal Reserve's dual mandate of full employment and stable prices, but it was also to sort of come to the quote-unquote rescue for the stock market. And for those of you who may pay attention to the financial media and some of that history, you have the Greenspan put. So anytime the market was in trouble, Greenspan and the Federal Reserve came to the quote-unquote rescue to save the markets, basically to put a floor underneath stock prices. So Alan Greenspan was in power in 1980s, 1990s, and then we had Ben Bernanke, Janet Yellen, and now we currently have Jerome Powell, chairman of the Federal Reserve. So if you go back to the 1980s, you can sort of see where this data goes, right? And it sort of peaks out at about 4%. We might get a little bit north of 4%, 4.1, 4.2, and then that's sort of where we peak out, and then it's like, well, we'll see you later, and we're probably headed for recession. Well, where are we today? Right now, we're currently around 3.4, 3.5%, and you have Larry Kudlow, chief economic advisor to the president. You have Donald Trump, who comes out, and they tout this number as it being a fantastic number, and of course, you have the continuous claims of this being the greatest economy ever in the history of the United States. Well, we're looking at some data that says, well, maybe not so fast, ladies and gentlemen, at least not in regards to average hourly earnings on a year-over-year basis, right? Because, well, we're at 3.4, 3.5 now. Well, all we have to do is go back prior to the Great Recession, prior to the recession of 2001, and prior to the recession of 1990, 1991, and you can see that we were north of 4% on a year-over-year change. Okay, so those are things to be mindful of. Now, we can clearly see here that the current trend is to the upside with average hourly earnings, and that's good for people. They have more money in their pocket. That's what you want to see. You want to see that type of growth. Of course, you have to ask the question, at what expense? And if you want to understand that, then you have to follow me on my podcast at the Kapital News, because we talk about those things all the time. But currently, we are in a strong uptrend. We've sort of had a plateauing effect, a little bit of a dip, and then we've resumed. Now the question becomes, will this continue? Will we make it up to 4%, maybe a little north? And then will the fat lady sing and say, oh, that's it, we're headed for a recession? Or, because we're in an even different paradigm, within a different paradigm, with negative interest rates, with zero interest rate policy, with quantitative easing, with central banks the world over, again, putting the pedal to the metal to throw more and more liquidity into the system, have we peaked out at 3.4, 3.5%, or do we have a little bit more room to run? Time will tell, but what we do know from the past 3 recessions, once we get to about 4%, that's it. We've peaked out. Now it's time to go back down, and we're likely to find ourselves in recession in the not-too-distant future, which, again, is evidenced in the 1990s, early 1990-91 recession, during the 2001 recession, and during the Great Recession as well. Okay, so that's average hourly earnings. Continuing, we now have average weekly hours of production and non-supervisory employees for manufacturing. And again, BLS, Bureau of Labor Statistics, and the Federal Reserve economic data. Now, this is just the levels of the data. This is your 40-hour work week. You can see here since the 1980s, we've been trending north of that. So if you're looking for overtime, you've been getting it. So that's indicative of maybe a higher wage, a little bit more money in your pocket. Those are good things. And where we find ourselves now is actually north of 42 during this last decade here, the last several years. But now we are in the midst of a sizable downtrend. I mean, that's a steep line. This is not a one-off. This is not just 1 week, 1 month. This is quarterly data, and we are continuing to the downside. Now, we have sort of what you might call a double topping pattern here. And of course, that's usually reserved for technical jargon when it comes to the stock market. But do we have a double top? And now are we likely to continue downward? Because that's sort of what we saw here, a double topping period or scenario, if you will, during the 1990s in between recessions. Okay, and during that time, between the 1990-1991 recession and the 2000-2001 recession, that was the longest business expansion in the history of the United States until our current environment. Okay, so we kind of get up there. We're north of 41 hours, just briefly, just a little hair under 42 hours per week. And the market says, nah, we'll see you later. And then we sort of drift along, and then we find ourselves in recession. We continue trending upward until the Great Recession, getting just a little bit north of 41 hours per week, and then see you later. And then we really dipped and went south of even 40 hours, which we have not seen since the 1980s. So that just tells you the severity of the Great Recession. And ever since, we've been recovering, got north of 42 hours per week a couple of times, and now we find ourselves again in a downtrend. If this continues, we're likely going to find ourselves in recession, because the other thing that I want you folks to pay attention to is where this data bottoms out. It's at the end of the recession, right? It's near or at the end of the recession. And that makes intuitive sense. Because like I like to tell my audience on the Capital News, anytime we're talking about the business cycle, the analogy I use, it's akin to climbing Mount Everest, or really any mountain for that matter, but let's just use Mount Everest as an example. Once you reach the top of Mount Everest, the only place to go from there is back down. Conversely, if you're at the base, if you're at the bottom of Mount Everest and you intend to climb it, the only way you can go is up. The same thing holds true in the business cycle. Once you have reached the peak of the expansion, the only place to go from there is down. It doesn't mean it's going to be drastic. It doesn't mean you're going to have a sell-off in the stock market like 1929 or back in the dot-com bust in 2000, 2001, or the Great Recession. It could, but there's no guarantee of that. It just means you've reached the top, and now it's time to go back down. And conversely, once you reach the bottom here, as you can see at the end of the recession, you're at the end of the recession. You're at the bottom of the mountain. You're going to climb it. Now you're going to go back up. And that's why we wait and see what the National Bureau of Economic Research says. And like I've stated in previous podcasts and in previous capital economics presentations, we're not going to get that official notice from the NBER probably several months, if not a year after. Okay, so we're going to be in recession, but it's not going to be announced. Why? Because there's a lag in the private and public data that comes out because there's multiple revisions. And so the committee within the NBER is simply waiting for all of those revisions to come in, and then they make their determination. But this is one of the things that they're going to look at. Continuing, we now have average weekly hours of production, and this is on a percent change from a year ago. Okay, so this looks a little dirtier, a little noisier, if you will. But nevertheless, it tells us sort of the same thing. And as we can see here, at the end of our data period, where we currently are, we see this steep decline. And that is very indicative of what we saw on the previous slide with that downtrend. That's exactly what we're looking at here, okay? Now, interestingly, again, we have several recessions to look at. Just because this data goes negative, goes below our zero line, which I highlight red here, just because it contracts, goes into negative territory, does not mean that we are imminently headed for recession, or neither does it mean that we are in recession. You can see here in the mid-1970s and late 1970s, early 80s, we went into negative territory, but we were not in recession, nor was a recession right around the corner. Okay? So this is just something to be mindful of. I always stress, like it was stressed to me during my years in college and grad school, make every observation possible. Do not overlook the small details. Don't overlook the obvious details. That's obvious, right? That's all we're looking at, because you might be able to arrive at a very profound conclusion that might be something that proves to be a very strong indicator and helps you along in your analysis. So observe everything and don't overlook everything and don't take anything for granted. So we have, again, this is a noisier data set, but just because we're in negative territory does not mean that we are in recession. However, typically, if you're in recession, we're always in negative territory, okay? Except here, okay? Now, are we pushing the envelope a little bit? It appears that we are pushing the envelope because we've been in negative territory a few times during this business expansion, okay? Again, the longest in U.S. recorded history, but we have yet to find ourselves in recession. Now here we were sort of in a mini recession in 2015, 2016, okay, and we found ourselves down about 1%. That was the mini recession within the manufacturing sector. It was contained to the manufacturing sector, did not travel to the broader economy, but now we're actually a little bit lower right now where we currently find ourselves. We are actually right around negative 1%, negative 1.2%. So again, something to be mindful of. This is the trend also that we're seeing. This is a further deterioration. This is something that is also in a negative trend. Will it continue or will it reverse course? Now, given everything else that we have focused on, if you have to play the probability game, it's more likely to continue to the downside, and it's more likely to indicate that a recession is somewhere around the corner. And that is also indicative. Again, if you analyze this chart, this graph, going back these several recessions, you see the same type of event. So continuing, we now have real personal income. Okay, and now this is just the levels of the data, just like when we were looking at the hours per week and it was 40 hours or 42. This is the same thing. This is just the levels of the data, not the year-over-year change or the rate of change. So this is real personal income. This is in billions of dollars. This is from the U.S. Bureau of Economic Analysis, the BEA, within the Commerce Department and the Federal Reserve Economic Data. And billions of dollars, and now we are at 14,000 billion. In other words, that's $14 trillion. That's a lot of money, okay? And again, we go back our data set from the early 1970s to today. And anytime that you see a recession, we'll just go back here to 1991, it peaks, levels off, comes down during the recession, and then it starts right back up again. Find ourselves there in 2000. We peak, we plateau, we come down through the recession, and then you continue trend. Great recession, we peak, we plateau, we come down through the recession, and then we continue trend. And that is what we are currently witnessing and experiencing. We are now at $14 trillion in real personal income in the United States. The question remains, just like it did in those other graphs. Have we peaked out, or will we continue? That's why this is a constant work in progress. All of this data needs to continuously be updated and monitored, but I think it's prudent, at least I do because of this website, this podcast. It's one thing to hear me discuss this data on a near daily basis. It's another thing to actually see it, and that's why I think it's prudent for me to put on these capital economics presentations so you can actually see the data that I'm talking about, so you can also, rationalize and do your own analysis to see where are we within this business cycle. Have we peaked, or will we continue? Time will tell. But that's the levels of real personal income. Now, looking at the percent change year over year, again, it looks a little noisier, but we're going to walk through this thing again as well, because what does it mean if we find ourselves below our zero line? Well, in this instance, every time we find ourselves headed into negative territory or contraction, we are in a recession. We are in a recession, except, you guessed it, this time, okay? During this business expansion, during this business cycle. Because back in about 2013, we got this big, sharp move into negative territory. But guess what? No recession. Every other time we went into negative territory in the 1970s, 1980s, we were in recession. 2000, the 2000s, Great Recession, that's where we found ourselves, okay, except right now. Now, the other thing I want to draw your attention to is sort of this other line that I draw on this graph here, this bluish, greenish line here, if you will, right about 3%, a little bit north of 3%, 3.3%, 3.4%. And the reason I'm drawing attention to this is because it appears, at least, and just allowing history to be our guide and what the data shows us, is if we hit this mark, and if we hit it from a point where we're coming from high to low, so it's a negative sloping line, if we hit this 3%, 3.2, 3.3, 3.4%, we tend to find ourselves either in recession or a recession is around the corner. Now, this is not foolproof by any stretch of the imagination, because you can clearly see there are multiple occasions where we are coming on a downslope and we hit it, but we're not in recession, nor are we anywhere near close. This is the mid-'80s. We didn't have another recession until the early 90s. So there was a clearly that did not hold water there, but it does on multiple other occasions. So again, this is noisier data. Typically, we do see a peak, which would be expected, before the recession, before the end of that business cycle. It's indicative that we are at the end or the ending phase of the expansion of the business cycle. You've reached a peak, you're coming down. You reached your peak, you're coming down. Now, this time it's a little different. We reached our peak shortly after the financial crisis, shortly after the recession. We've never regained that. Personal income on a year-over-year basis never topped 6%. Now, that is probably due to the fact that the severity of the Great Recession was as bad as it was. So your comp, your year over year, that made the big difference. But nevertheless, that was when we peaked, and we have yet to recover. Now, will we recover? That's another question. We are starting a little bit of an uptrend here. Once again, where we find ourselves, will that continue, or will this roll over as well? Time will tell. But that's all we're doing here with the Capital Economics. We're simply looking at the data that the National Bureau of Economic Research is going to be reviewing to make their determination as to when we are in recession, when this expansion has peaked. And given the presentations that we have done on unemployment, the presentations that we have done with what central bankers are doing, with the yield curve of varying durations and other data points that we talk about on a near daily basis on the Capital News podcast, I personally believe that a recession is around the corner. And if you follow the podcast and a handful of other things that we talk about, such as the Cass Freight Index, they are predicting that the United States will enter at least negative GDP either in the third quarter or the fourth quarter of 2019. So there's a lot to be paying attention to. These numbers are going to continuously be monitored. Please continue to follow us on thecapitalnews.com. Please like, share, subscribe, get the word out, and leave your comments. We do love hearing from you. Again, you can follow us on thecapitalnews.com, our YouTube channel at The Capital News, and on Apple Podcasts at The Capital News. And you can also follow us on Twitter. Another way to support the channel and the blog, you can buy our book, The Cynic's Guide to Investing. In the era of too big to fail, it pays to be a cynic. This book was published in 2015. You want to understand what was going on during this entire monetary experiment. You want to understand the intricacies and the interconnectedness of the economy, the government, the stock market, the bond market, everything. You buy this book. You put this in your library, and you read it, and you study it, and you understand it. And if you're ever scratching your head what's going on, it's in your library. You pull it from the shelf, and you're going to find a chapter that is explaining something that's going on in this economy. We predicted what was going to happen thereafter, 2015, and where we find ourselves today. My co-author and myself were very much in the bull camp when we wrote this book, and shortly thereafter. Now we're starting to change gears, shift gears a little bit, that this monetary policy, things are, diminishing marginal returns are starting to kick in, and we explain that in the book as well. So we do hope you take the time to buy our book, The Cynic's Guide to Investing. We truly do appreciate it. Thank you so much for joining me today, ladies and gentlemen. I hope this presentation has been informative, and continue to stay diversified, stay vigilant, and stay with the Capital News. Thank you.